We're pleased to be joined today by Moshe Milevsky, professor at York University and Toronto Schulich School of Business, and a provocative and unconventional thinker about lifetime personal finance. Read his book, Your Money Milestones, and you'll never look at some of your money questions in quite the same way. Thanks for joining us, Moshe.
Thank you.
Moshe, you ask most people what their biggest asset is, and they'll tell you it's their house or their 401k. But you have a different take on it. What is the biggest asset?
Yeah, if you take a look at the personal balance sheet, which lists all the assets that people have, the house is certainly one of the bigger assets, and definitely the investments are. But the real big investment on the personal balance sheet, especially when you're very young, is something that economists call human capital.
Human capital, what is that?
Human capital. Human capital is very different from financial capital. Financial capital are things that you can sell today or auction off on eBay. You have a value, you get a statement at the end of the year or the month of what it's worth. Human capital is the value of all the wages, the salary, the earnings, the bonus, the commissions that you're going to earn for the rest of your life. The best way to think of human capital is like a company with a gold mine or an oil well, where it's deep in the ground and it's going to take many years to get it out, but it has a value today and it's placed on the corporate balance sheet. Human capital is the same thing. The next 20 or 30 years of your life and the earnings potential is worth something today, and for many people it can be millions and millions of dollars.
There's another kind of capital that you mentioned in your book called social capital.
Yes, I think overall there are three types of capital when you take a look at what capital individuals have. One is financial capital. Pretty obvious, everybody understands that. The other one is human capital, which I just mentioned. And I think the third one is social capital, which is something that's much more subtle. It's the time that we invest developing relationships with our communities. It's the babysitting that you do for your neighbor when they're in a pinch. It's the carton of eggs that you lend them when they can't get it because the store is closed. It's those relationships that you build that allow you to tap into it and create reciprocity. You can't put that on the balance sheet as easily as human or financial capital, but that's a very important form of capital, and it explains a lot of behavior. You know, a lot of people have houses now that are worth less than the actual mortgage on the house. Why aren't they walking away from them? Why aren't they defaulting? I mean, financially speaking, there's really no value in keeping to make those payments. It's because of the social capital that they've created. They're in a neighborhood. They want to continue those relationships. They may be embarrassed to walk away. Embarrassment comes from social capital. So social capital, just like human capital and financial capital, drive decision making, those three types of capital.
Most people think that their first financial goal when they get out of college ought to be to buy a home, presumably by their early 30s, as soon as they've saved up that down payment. You disagree. Why?
You're taking a very large risk by doing that, and let me explain why. When you are young and you have a lot of human capital, something I said earlier, that human capital is very illiquid and it's undiversified. So you study to be an engineer, your human capital is in engineering. You're going to be a physician, it's going to be in the medical field, but it's very illiquid and it's undiversified. You can't split or diversify your human capital. You can't be a doctor on Monday and an engineer on Wednesday and a physicist on Friday. It's undiversified. To go out then at that early stage of your life and take another asset that's very illiquid and very undiversified places two very undiversified assets on your balance sheet, and it may not make a lot of sense from a financial planning point of view. Whereby later on in life, when you've converted some of your human capital into financial capital by working, saving, investing, then you have a slightly more diversified balance sheet. You can afford to take on this illiquid and highly concentrated position. So if people could buy a house where, you know, maybe one bedroom is in New York and the other one's in LA, and maybe there's a kitchen in Costa Rica, and well, then they have a diversified portfolio of housing. That's not as bad. But you're really taking a bet on one region, one sector. That's very volatile. It doesn't make sense early on in life. That's number one. And the second, just as important aspect of it is that you're really buying this with a huge amount of leverage. Nobody buys a house. They put down 5%, they borrow the other 95%, and that's a leverage ratio that can approach 20, 25 to 1. I mean, you're running a hedge fund in a sense. You're a highly leveraged hedge fund, and we know what happens. The asset value goes down slightly, you blow yourself up because of leverage. That also doesn't make sense early on in life. This idea that you buy a house and it'll continue to appreciate by 5 to 8% a year and beat inflation, the last few years have proven to us that's not the case.
No, that's true. Although that belief seems to die awfully hard in people.
And it's regional. I mean, there's certain areas where it hasn't been affected that way. But I think we have to think more critically about the housing decision. And this has social policy implications as well. Do we really want to advocate that everybody should own a house? Does this really make sense? There are certain countries where the home ownership rate is much, much lower than it is here, and they tend to rent, and they're equally happy. We have to think more critically about it.
Oh, very interesting. Most of us have built our retirement plans around 401ks. Maybe not, that wasn't our idea, but that's the way it has shaken out in this country. But you believe that people, even people who don't have a pension to carry them into retirement, ought to construct one. Why?
Yeah. What I'm recommending is that people should take some of their 401k and pensionize it. They should buy investment products that will give them an income that's guaranteed for the rest of their lives, and with the rest of the 401k they can diversify and hope for growth. The last few years have taught us many, many lessons about financial planning. Housing is one of them. The other one is that a 401k or a 403b or even an IRA is not really a pension. It is an investment account. It's tax sheltered. It's very volatile. You have very little idea what the value will be when you will have to retire. It's only an expectation. Make sure that when you get closer to retirement, convert it into something more pension-like.
Like an annuity.
That would be one example. There are many structured products out there that do it. Maybe a mutual fund that provides you with constant payments for the next 30 years. So they invest in bonds or in real return bonds, tips, and they slice it up and they give you a constant predictable payment for the rest of your life. This idea of withdrawing money from a 401k slowly and that being a pension is something that we've come to realize is not true.
Very interesting. Moshe, thanks.
Sure, thank you.
And thanks for watching.